This episode is brought to you by The Guarantors. Chasing down residents who don't pay their rent is taxing enough. Did you know you could offset the risk of renter default? Meet The Guarantors. They'll requalify your applicants and insure their rent. If the resident doesn't pay, you still get paid. Visit theguarantors.com/multifamily today. Welcome to another episode of the Multifamily Collective. Today I wanted to talk about some further tells in the marketplace as it relates to multifamily transaction volume starting to pick up, or at least the predicates are being put in place for that volume to pick up and or to take advantage of the volume that might pick up very soon. As we talked about and as was reported on other outlets, earlier this summer, we had several institutions buy very big portfolios, I think billion or multi-billion dollar portfolios. Transactions happened earlier this year. Really kind of the very beginning of this next real estate cycle, or at least some would suggest that this is the beginning, or that was the beginning of the next real estate cycle. So two stories came out today on BizNow. One was about Waterton closing a $1.7 billion fund. And the headline goes, to pounce on historic pricing disruption in multifamily. And then Ares raises a record $3.3 billion to spend on distressed real estate. And I think here it talks about most of that capital, most of that raise will go toward multifamily, if not all of it. So that's $5 billion in those two multi-billion dollar transactions that happened earlier this summer. There are organizations out there, there are firms out there that have raised and will continue to raise funds, multiple funds to go after distressed real estate. My question is, much of, or many institutions, many players in the real estate space have been able to take a phrase from Wall Street or from a pundit, is they've been able to kick the can down the road, or they've been able to reorg their debt structure so that, or raise a little more capital to put into deals to forego a repossession, so to speak, of an asset. Many firms have been able to do that. They've been able to sort of kick this can down the road such that now that interest rates have adjusted by 50 bips and could potentially go another 50 bips before the end of the year, debt, as it relates to the income side of the P&L, is starting to become a little more relaxed. And does that mean there will be fewer distressed assets in the marketplace for these big funds, these big raises to go after? And does that impact downstream? Does that impact firms that don't necessarily have big funds that they use to go after multifamily assets, but rather just family offices that have, 1,000, 2,000 different mom and pop type investors? Does it impact them? And if so, how much? That is to say, when they're competing out in the marketplace to buy deals against the Watertons of the world, the Ares of the world, the Blackstones of the world, the BlackRocks of the world, and more institutional grade funds or firms that put together funds to go chase deals, and because they are forced to place that money in an aggressive fashion, does it make it harder for the downstream player, the middle market player, to actually acquire assets in volume, in mass, like they did back on the heels of 07, 08. So let's say 11, 12, 13, or 10, 11, 12, when they started to accumulate assets in the last cycle. So I'm inspired, excited by the new cycle starting to see these tells that are coming into the marketplace. But I am curious what you think out there in the multifamily collective world as it relates to this. Is it a tell? Have current owners been able to kick the can far enough down the road that now, with interest rates coming down and that P&L getting relaxed a little bit, or at least the expense side of the P&L getting relaxed a little more cash flow into the equation, will we not see as many distressed assets as all of these funds are hoping for? Take care. We'll talk to you again soon.